Data and earnings show it's all about the consumer. Welcome to Market Insight. I'm David Pollard. Q1 GDP was revised downwards in today's data, now showing at an annualized 1.3% against a first estimate of 1.6%, and notably slower than the 3.4% of the prior quarter. That as consumer spending was downgraded in line with recent softness in retail sales. The numbers come too on a day when Best Buy topped profit expectations and Dollar General posted an upbeat first quarter, but Kohl's shares cratered on a surprise quarterly loss, reflecting the mixed picture of consumer trends seen in some recent retail earnings. So what to make of it all? Well, joining me now is Jack Janasiewicz, lead portfolio strategist at Natixis Investment Managers, who have $1.3 trillion of assets under management. Welcome, Jack. Many thanks for joining us today. We also had a Fed survey today showing companies worrying about weakening consumer demand. This issue, these fears around the consumer appear to be gaining traction, don't they?
Yeah, it certainly seems like we're getting a little bit of traction on that front. But, when we start to look at the actual data, to us, it's a little bit more bifurcated. And, what do I mean by that? Well, if you start to break out some of the potential buyers here within income buckets, I think we really start to see that lower income basket really being squeezed in here. And I think the one takeaway that we would have, even that lower income basket still has the highest marginal propensity to consume. In aggregate, there's still about 8 or 9% of total consumption expenditure. So at the margin, might they have an impact on the overall growth backdrop if they start to slow even more? Maybe, but the bulk of the spending still comes from the higher echelon in terms of that income basket.
So to what extent are today's downgraded growth numbers a worry then? What factors are at play there?
I'd also argue that maybe it's not quite that bad simply because I think the market's more worried about the inflation backdrop. And so if the growth numbers are actually revised higher, I think the pass through to inflation might become a little bit more of a concern. And quite frankly, we saw just the opposite. So revisions that we saw today basically were, I think, not really pushing that inflationary button, so to speak. And that's where I think the market's a little bit more comfortable.
Well, as you allude to, low-income consumers have been feeling the pinch, but the better off are still spending and are likely to continue to do so amid a strong labour market. That's obviously very important. So are fears over inflation very much overdone in your view on the part of the consumer and also on the part of the Fed?
I think there's still a little bit ways to go, but if we step back and take a look at the big picture levels here, when we look at what's going on in the labor market, it continues to rebalance and normalize. When we look at wage pressures, those are actually continuing to trend lower. And so you sort of put all this together, and I think the inflationary impulse, if there was going to be one, would have to come from rising wages coming from a stronger labor market. And we're just not seeing that right now. So, again, longer term picture, we're probably heading in the right direction. It's going to be fits and starts along the way, getting back to that 2% target. But I think the big picture level is the labor market's cooling and it's moving in the right direction with regard to inflation.
So what does that all mean for the Fed? I think in your notes you say a September cut is still on the cards.
Yeah, there's a few things to think about here. First of all, with regard to the potential for rate hikes or rate cuts, I think the bar is still pretty high for rate cuts, but even more importantly, the bar for rate hikes is even higher. And so when we start to think about that backdrop, the mantra I think is at least for now, higher for a little bit longer. But I think that also brings into play the potential for a cut in maybe September, and possibly even one more at the end of the year. So I'm not certainly ruling out the potential for rate cuts. It might just come back a little bit later. And I think that's more important for the market. And that's simply, we're not looking at rate hikes anyway going forward.
So where should all this take the investor? Tech is overvalued in the eyes of many, and share markets continue to bounce around on fears over inflation and the Fed. And yet equally, Kohl's, as we mentioned, saw its shares sink today. Where does one seek value without too much risk or volatility?
From our perspective, to start to see a little bit of a broadening out in market breadth, I think that's going to be a factor of what happens with regard to that interest rate outlook. And so I think the market needs to become more comfortable with the rate cut cycle, that maybe the peak in the 10-year yield is behind us now, and we'll start to see rates continuing to trend lower. When that backdrop starts to hit, I think we're going to start to see a broadening out. When we do get to that point, small caps, mid caps might start to get a little bit more traction. And I would argue that you might also see that in maybe more of the cyclical value names. So things like financials and industrials. But in the meantime, we certainly would expect to see tech and large cap growth continuing to still pull its weight.
Okay, Jack, we'll leave it there. Jack Janasiewicz, lead portfolio strategist at Natixis. Many thanks for joining us today and sharing your thoughts. That is Market Insight. Don't forget you can watch more videos on Reuters.com.